Chapter 3, Central Banks. Section 1, Role of Central Banks. A central bank is the institution at the core of a country's financial system. Its job is to manage money and credit conditions for the whole economy by issuing currency, influencing interest rates, and helping keep the banking system functioning smoothly. It helps to separate the central bank from other institutions. Tilstig sounds similar. The treasury handles government spending, taxes, and borrowing, while commercial banks serve customers with deposits and loans. The central bank focuses on monetary policy and overall financial stability. Across countries, the details may vary, but the core responsibilities are usually familiar. Central banks aim to preserve monetary stability, support financial stability, issue currency and oversee payment systems, and in some places they also supervise banks directly. The most visible part of that job is monetary stability. By changing the policy interest rate, a central bank affects borrowing costs, which then influences spending, investment, and ultimately inflation, with the goal of keeping prices low and predictable rather than chasing growth at any cost. Banking runs on trust, and when that trust starts to crack, trouble can spread quickly. In periods of stress, a central bank may act as lender of last resort, providing temporary liquidity to solvent banks, so a panic does not turn into a wider financial crisis. Central banks also help make money usable in everyday life. They support trusted currency, keep cash available, and oversee the systems that allow payments and settlements to move safely through the economy. Policy works through a chain of effects, not through direct control of every price. A change in the policy rate influences market rates and credit conditions. Banks adjust their loan and deposit rates, and then households and businesses respond through spending, hiring, and investment. That influence is real, but it has limits. Central banks cannot guarantee long-term growth. They do not control every borrowing rate, and in a deep downturn, rate cuts alone may not be enough without help from fiscal policy. Their decisions often involve uncomfortable trade-offs. Pushing inflation down can weaken demand and slow hiring, while supporting jobs more aggressively can keep inflation pressure alive, which is why independence and credibility matter so much when hard choices have to be made. You can see that in major shocks like early 2020, the Fed cut rates to near zero and the ECB kept conditions highly accommodative, not because they could erase the shock, but because they could stabilize credit, support confidence, and limit financial damage. Sometimes the hardest situation is when inflation is high and employment is weak at the same time. If inflation is running far above target while unemployment is also elevated, tightening policy may help cool prices but can also put more pressure on jobs, and that is a genuine policy dilemma.